so today we're going to continue on with looking at some examples with different types of financial instruments. And last time we left off with forward and futures contracts. What was the connection between the forward contract and the future contract?
Was it that you're setting the price?
Yeah, you're setting the price in the future, so it had that common element. What else was common about the forward contract? That was the apples and apple pie. I kind of use that example each time, but one was called a forward contract, one was called a futures contract. What was the main difference between the two? Conceptually, they were very similar in a sense. Isaac?
Was the forward one almost like a soybean in the future?
No, I mean, it can be soybeans in the future, yes, but there's a fundamental, they're very closely related, but there was one distinction we made. You got it, Jake?
Would you go to certain prices of the crop first, more from
Okay, that was with the margin calls, which actually could be done similarly with each one. But the very first thing with the apples and apple pie, they say counterparty risk. That's probably the main thing. So with the futures contract, what was true about the nature of the contract? It was set up as standardized, right? So you can go on the Chicago Board of Trade and buy apples contracts, right? Whereas the forward contract is actually a contract between two parties. And so you've got the apple farmer and the apple pie producer. They're free to make a deal with each other and say, hey, how does this sound? I'll take your 1 million pounds of apples at a fixed price in November, period, done deal, right? And then you have the counterparty risk and all that. Whereas the futures market now, Wall Street has a brilliant idea so that they can make a little bit of a commission, right, between the spread between the selling price and the buying price. Hey, I'll take away some of that counterparty risk by managing the deal, and I get a little cut, right? So we made a standardized contract that really functioned similar to the forward contract, but now people can get in and out of it and not have the same counterparty risk that they had before. And so the counterparty risk was minimized by the last thing we did. What was the last thing we did? I think this is what Jacob was talking about. Why does the seller not have to worry if the price looks really bad for the buyer? Why do they not have to rely on it? What is the broker doing? Margin accounts. So the margin calls now is really the instrument that keeps people honest, so to speak, right? So that they are paying their losses as they go, and the other party is getting their gains as they go through changes in their margin account. And then that way, if the apple farmer goes broke, it doesn't matter. There's other apples to buy at the market price. And technically, we kind of set it up that the way I showed the profits was that you buy the apples at market price, but you're actually not buying it from any one particular farmer, right? It doesn't matter. It's just the market price. Like all the farmers are bringing their apples to market, and that market price was 10 cents a pound, right, in our example. And so you don't care what farmer you're buying your apples from. And under these circumstances, we're assuming apples are basically homogeneous. You don't care what farmer you get them from. Not like one has more worms and one has less pesticides. So we're assuming that the apples are homogeneous, then you don't really care. So then this futures and the futures contracts have really set up a way for buyers and sellers who don't know each other to basically take advantage of minimizing risk of price over time. All right, so does anybody have any questions on that so far? All right, so today we're going to look at the financial markets. So we're going to do kind of a similar thing, but now we're going to be using bonds. And maybe before I do that, I was going to do this after the example, but maybe I'll show you right now. I think it's kind of helpful. The last thing I showed you was looking at the number of contracts. So we don't have I guess if there was a disadvantage, it would be that the buyer and the seller can't do a deal at $125,654, right? So they have to be in those standardized amounts. And so that would be one disadvantage of this. I'm not even gonna put the screen down. I think I'm just gonna show you this little table here. See what comes to life. Oh, I'm not on this. That's weird. What the heck is going on here? Is that thing on? Oh, yeah, there's a funnel. That's what it is. The lights just now. Okay. All right, I will do it in my other order while that thing warms up. It's not that important. Okay, so let's start our example here. This is really straight up. Your book has a nice example that we can just kind of run through in a little bit shorter fashion. So let's say you're currently holding $5 million of sixes, 2038. $5 million of sixes, 2038. So what does that mean? It means that you've got a coupon rate of 6%. 6% coupon rate on the bonds that you're holding, and those come due in 2038. So you're holding $5 million of sixes that are going to be done in 2038. So since my light came on about the right time, I guess this is fine. So the book has just kind of a list of these types of contracts that we have for futures. These are the popular ones. So treasury bonds, treasury notes, treasury 5 years, 2 years, 30-day Fed funds rate, euro dollar. So all of this stuff, these are kind of government-related interest rate contracts. And so they're in $100,000 and $200,000 standardized sizes like we talked about. So you're going to think about how many contracts you want to buy. And then this was just the volume that's going on as of 2017, just to get an idea. Then there's contracts that are based off of like the S&P 500. So you can buy the S&P 500, right? You guys know that. So like we talked about mutual funds. Instead of going out and buying all 500 companies, you can go to a company like Vanguard, who has a mutual fund called the S&P Index Fund or something, and you buy one share, which might be $100, one share of Vanguard's S&P 500 Index Fund, and when you spend your $100, you instantly bought all 500 companies, right? You're basically buying the index in a sense. So when you hear on the radio or on your news feed that the S&P 500 is up 3%, your mutual fund's up 3%, right? Even though you're buying the stocks that are inside the index. Remember, Standard & Poor's is keeping track of the performance of different financial assets and other things. And so this is one of their metrics that they developed years ago. It's like, oh, well, let's take the 500 biggest companies, and that'll kind of give us an idea of what the market is doing, at least for those types of stocks. And then eventually, financial products like mutual funds and ETFs evolved. ETFs are a little more modern of exchange-traded funds, so it kind of operates similar to a mutual fund. And you can buy the whole market, essentially. And so now, you can also buy futures contracts. So if you think the S&P is going to dog it tomorrow, you don't have to buy that mutual fund and take a long position. You can potentially take another position on the whole index. Right? So you can do a futures contract to deliver at the time. And basically, instead of delivering apples, you're exchanging money on the S&P 500. Right? But same thing conceptually with a futures contract. You're agreeing to deliver a certain amount of shares, or if you're a short seller, you're going to buy a certain amount of shares, right? You're on one side of the market or other, and you've got people on both sides of the fence making a bet on whether the S&P 500 is going to go up or whether it's going to go down, and then those are going to be priced accordingly. And they're going to be, if it's If it's really likely that the stock market's going to boom, then the price is going to adjust accordingly. It's going to be really expensive to buy those shares. If it's likely that it's going to bust, then it might be really cheap to buy those options, or the price of these futures contracts. Okay, Lawson.
I was just curious which one contracts on this are.
So they have, these are all they're all futures contracts.
Okay.
So you are betting on what's going to happen in the future with those amounts. So you're agreeing to make that trade, and then you've got the 250 times the index is the size of the contract that you have to put up. So they could be they're usually pretty large, like to buy one contract. And then they get into mini contracts. Actually, I guess the word mini is here. Yeah, they do mini. The size is smaller. And they have mini ones for these two so that they're not in $100,000 increments. Because literally, to play this game, if you want to buy that, you need $100,000 bucks. Right? They're in $100,000 blocks. And so then they've created other instruments that are mini, like, okay, I want to do 20,000. Well, okay, so then maybe there's a financial product that's developed for these minis that'll be a smaller block size for some smaller traders. Okay, and then let's see, there's one more, and then we'll move on with our example. Currency. So British pound, Swiss franc, Mexican peso, euro. So you can play the same game with currency. Now, the game that we're playing is not typically a gamble. That's not what a hedge is. What was the definition of a hedge that we started off with on Tuesday?
Mitigate risk.
Mitigate risk. So what we're really doing is we're saying, okay, I've got a contract with a Japanese company, and we are going to be trading in yen. And right now, today, we're trading at 100 yen per dollar. And I don't want to take the risk 30 days from now of what the yen's going to be at. So I'm going to use the futures market to basically offset that potential risk. I'm going to take an opposite position to holding the contract. They're going to deliver me X amount of product with 100 yen. I take the opposite position so that I lock in that I'm paying 100 yen even 30 days. So it's possible to lock in that price just the same way our Apple farmer did, but you're using currency in that case. Questions or comments there?
So how would you do that? This example that you just provided at the end, you I don't even know how that works.
Let me go through this example because you'll see some of it here with this one, and then we can see if we want to expand it further. All right, so here's kind of the setup for this. So in March 2019, the sixes of 2038, I'll put that in quotes because that's what we're calling these things, right? So you're currently holding 5 million of the sixes of 2038. Now today in March 2019, there are long-term bond. This is just kind of defining it. To be delivered in the Chicago Board of Trade, CBT, and it's usually CBOT futures contracts. Expiring in 1 year. March 2020. And the assumption we're going to make here is that the expectations of the market is that interest is going to stay at 6%. So interest is expected to stay at 6%. So the sixes of 2038, these particular bonds, and the futures contracts associated with them are selling at par. Are selling at par. Okay, what does selling at par mean? Maybe from some other classes, we talked about it in different ones.
Minimum price.
Oh, what?
Minimum price.
No, not so much to be minimum.
It's the stated price, but it was
So the stated price is kind of like stated. Let me help you out a little bit that if it's not at par, it's either selling at a premium or at a discount is the other word. But at par means something a little bit different. JC? At the break-even point. Kind of what we're looking at for break-even, unless somebody else want to add in? Yeah, Eddie?
It's their issue price.
The issue price. So if it's at par, then, and we had 5 million of these things, it's still 5 million, right? So at par, there's no difference that's taken into account because interest rates have gone up or interest rates have gone down. So when interest rates go up, what happens to the price of bonds? The sale price today of something that's going to expire in 2038. If interest rates today go up, what happens to the price if somebody wants to dump this bond today? It goes down. If interest rates go down, bond prices go up. So that's what we're talking about here with the long position, by the way. So one thing to keep in mind that's a little confusing, I think, for people trying to learn this stuff, it can be confusing for me too, is that the long position isn't holding this until 2038. You can think of it that way. That's ultimately when it ends. But really, the long position is just buy low, sell high. So if Wall Street allows me to buy this thing for 4.3 million today because the bonds are selling, and I'm going off of this example, because the bonds are selling at a discount given the interest rate environment, and I want to hold this thing for 2 years because I think that interest rates are going to go down is my prediction, is my bet, which means the 4.3 million might raise to 5.4 million. I call up my broker and I dump it, right? I took a long position on the 2038s. You with me on that? Is everybody with me on that? I got some heads shaking. So the bonds don't actually come due until 2038. That's just when they finally pay off. But if today is 2021 and I'm making this bet for 2023, the bonds still have life for another umpteen years, right? So in this time frame, and maybe this thing was issued, if this was a 30-year bond or something, it was issued back here. I'll just make up a date. So this thing, the U.S. government put this into place in 2015, and it expires in 2038. That's what the government is doing. And then because it's a marketable financial security, Daniel can buy it and sell it to Jacob. Jacob can sell it to Luke. I can buy it, right? It can trade hands. That's what we're talking about here, is that depending on the current interest rate environment, we learned how to value these bonds before using present value stuff. The value of that face value of 5 million on these bonds today, given the current interest rates, is 4.3. You think interest rates are going down, so you buy the bonds. Sure enough, you were right, and you made some money. You took a long position. If I thought interest rates were going to go up even further because the Biden administration came into play or something, and we have $1.9 trillion of COVID debt that's coming on board on top of the other trillions that we've already taken out, and I think interest rates are going up, well, I can take a short position on these bonds. And maybe at the end of the day, I end up cashing out for 3.1 million. If that's my bet, I'm going to take the opposite position. And I took a short position on the 2038s. From 2021 to 2023, I just took a short position because I thought interest rates were going the opposite direction. So then there's traders on both sides of the market. Some think it's going up, some think it's going down. They enter the market, they trade these things. Okay, questions or comments there? Probably the key thing with this one is that we're assuming you are the owner of these bonds, right? So you're currently holding 5 million of these bonds. And now what we're trying to do is hedge. So we're going to try to take the opposite position with a hedge. All right, so how many contracts do we need to buy? How many contracts do we need to buy to do an interest rate hedge at this point? So what we're going to do is to hedge, we need to offset our long position with a short position. And so last time I left you off with how many contracts do we need? What was that formula?
Number of contracts equals the value of assets over the value of contract.
All right, over the value of the contract. So now we've got $5 million worth of these 2038s. So 5 million. And the value of the contracts, as we were showing, are standardized. And for these contracts, it's $100,000. $100,000. So we need to buy 50 contracts. 50 futures contracts. And with the futures contracts, it's just saying, I've got apples today. How many apples you got? Well, I've got $5 million worth of apples. And I'm going to buy a futures contract where I promise to deliver $5 million worth of these apples in the future. Okay? All right, so how's this going to work? Let's see. So if, let's do a couple of scenarios here. So what if interest rates increase? If interest rates increase to 8%, what's the value of our position going to do? Did it help us or hurt us? Goes down. We started at par, and so now in my portfolio, my $5 million worth of bonds at current market prices is worth less than $5 million. So the author's got some calculations. You know, we go through the normal bond process. So he's got it worked out here that the value on March 2020 at 8% is equal to $4,039,640. And of course, the value on March 2019, when we bought these things, or when we own these things, at par, the 6% was $5 million. So are we up or down? We're down. The difference between the two. So the difference between the two is we've lost $960,000, $960,360. $960,360. That is on our long position or short position that we're down? Long. On our long position, we're down. So we also bought the short though. So the short position, has a value of the same thing, $4,039,640. So with that futures contract, But, here's the big but, how we make money. But the buyer of the futures contract agreed to pay $5 million on March of 2019, a year ago. So you had that covered already because that was the short position you took. I'm going to deliver you 50 contracts. You give me $5 million. Somebody took them up on that. And so the value today is 5 million minus the 403,960 gives us a gain of 960,360. So how much money did we lose overall? Zero. A perfect hedge. Now we're ignoring a little bit of, transaction costs, other things, but that's the idea of taking out a hedge, leaving you in a position where you're at where you were at before. You had 5 million in 2019. You wanted to be absolutely sure you had 5 million in 2020. The futures market allows you to do that. You can maintain your 5 million. Now you would have been, when would this person been kind of kicking themselves, hindsight 2020, the old regret factor that we talked about. It's not rational to say you made a bad decision, but
March 2020 when it's 4 million instead of 5 million.
yeah, so when it goes the opposite direction, interest rates fell to 5%. My bonds might have went up to, let's just pick out a number, $5.9 million, right? I would have been up. Woo! I would have been up 900,000. But what did I have to do here? I had to sell. And so I had to do just the opposite. Now I'm going to lose 900 on the short part. I gain 900 on the other part. I'm still at 5. But kind of hindsight 2020. Oh, I should have had a crystal ball. No, you shouldn't have had a crystal ball. You did what you needed to do to mitigate the risk. In this case, eliminate the risk. Okay, questions or comments on that? All right, so that's the hedge concept using futures. And the next thing we're going to do is talk about options. So options are different than futures. So how are they fundamentally different than what I obligated to do in the futures market? What did this buyer, by buying a futures contract, what did they obligate themselves to do?
They 5 million.
They had to provide the 6s, they had to provide 50 contracts of the 6s at 2038, right? They obligated themselves to deliver that at the time. So that had to be done. With an option, what's true? Eddie?
We pay like the, not sure what the fee is called, but it's like the brokerage.
Yeah, a premium is what we'll get to, yeah. So you have to pay a little bit, and so what does that allow you to not have to do? Since we call it an option, you have the option to cancel it or not do it, right? Okay, so that's the options market. It's again, kind of related to this, but Wall Street had an idea, oh, well, we can make some money by allowing people the option to not carry on something. All right, so there's two types of options. So let's say options. So there's an American option, which is the one that we'll do most likely, not, it's the most popular type. So the American option, the key difference is that it's the right to buy or sell can be exercised at any time up to the expiration. So the option to buy or sell can be done any time up to the expiration. So, quick little example: you buy a option to buy GameStop. What are they at now? Anybody still tracking? Don't Google it. Are we all burned out on it? What is it? Russ, is it still hanging around 50? Okay, so let's say that you have the option to buy GameStop at 60 over the next, or let's say let's just put an expiration by what are we in February? So January or February, March, April. Let's go by April. So these would be the April options. So it's basically going to be April 1st of 2021. That's the expiration date. And so you're just going to have the right to buy it at 60. So what are you hoping GameStop gets up to by the time you get to April 21? You want it higher or lower than 60? Higher. Higher. So if GameStop's selling at 70 or 300, if some other wacky thing happens, right? Then you buy it at 60 on that day and you go up. So if you want to sell it earlier, if GameStop goes up to 300 in March 14th, and it goes up to 300, you can dump this puppy right there and take your money, right? You're in the money because GameStop is higher than your strike price. You don't have to write all these terms out right now, but I'm just kind of getting you the window here. So when you have a market price above your strike price, you're in the money and you can cash out. A European option, you can't. You got to wait till the end. So that's the counter to this. So is that self-explanatory? Do I have to write to sell anytime? Option to buy, sell anytime up to the expiration date? Good enough. European option. The owner of option must wait until expiration. Until option expiration date. So you're going to have to hold on to it to the end before it can be turned and burned. So most of the time, the options are American options. I think it kind of started in Europe doing it that way, and they were just used to doing it that way. So there's still some of those that are out there, but not the most.
So you could potentially, say like for the example of GameStop at $60, you could potentially just buy it early and then make $20 or so on it if it goes up in the future.
Yes. Yeah. Basically, you have the ability to make that happen now, and the person on the other end with the option is having to pay that difference at the time of the market.
And then they go, so how does that help her then? Because if they're having to pay the difference, the only time they would make money off that is if the price would go down.
Right. They think the price is going down, and they're like, I'll give you these all day long at X amount. We'll get into the X amount of another example. So when you buy this, there's a price for the right to be able to do that. And that's where we'll get into the premiums and how much you're paying.
Gotcha.
I'm going to go through a full example. All right, so we've got two types of options. A call option. What are you doing there with the call? Buying or selling? Buying. So you want to think about this being a right to buy a financial asset at the exercise price within a specified period of time. The right to buy a financial asset at the exercise price, and a put option is the right to sell. Dot, dot, dot. All the rest of it's the same. All right, let's see. Get rid of this. Use the whole board. Okay, so suppose we got, for example, stock options. So we got company. What's our company today? What company do you want to trade? It doesn't have to be a real company. It can be a fake company.
Dinosaurs Incorporated.
Dinosaur. So I'm going to say company Dino for short. Trading symbol DI, and there's something. Okay, so company Dino has a current price of $50. The current stock price. And so here's the thing, you've got company Dino over time has been, doing the kind of normal thing, up, down, up, down, up, down. And then here's where we're at today. So today, company Dino is at $50. This is the price of Dino. And so you think that the price over time, you're hoping that tomorrow, maybe in 1 month or something, you've analyzed your charts and you're pretty hot to trot. It's probably going to go up and down. But you think that tomorrow you're going to be at $80. So you could just take a long position, buy company Dino, and ride it out, make your $30 a share. Or if you want it to be a little less risky, because you think it's going to go up, but geez, you never know what's going to happen. We just had a change of administration, and the dinosaur market is kind of wonky here right now. That you just would rather maybe do an option. So let's say we've got the ability to do a call option for just $5. And there's a strike price of 60, which is also the exercise price that the author was using. And the expiration is in 1 month. So there's your call option opportunities. Because you don't know if dinosaur might go down, and let's say we have outcome B down here. Outcome B and outcome A. So that we can analyze the difference in each scenario. Where this one's not so good, came down to $20. We don't have a perfect crystal ball, but those are two possible things. Certainly that could happen. All right, so what's the profit looking like with our long position versus our option? So if we have an end price, we'll do a little table here. If the end price ends up being $80, outcome A. If our end price is 80, how much did we make? 30, right? We bought it at 50, we took a long position and got up to there. So with our long position, with the stock purchase, we would have plus $30. That's just the 80 minus the 50. So we made 30 bucks. And if we did the option, how much did we make? 25? Think about the elements of the option here. So this is the option price. You paid $5 to have the right to buy it. You didn't have to buy it, but you had the right to buy it. So 15?
20.
20 I hear? 15, 20, I've heard 25. Do I hear 30? Go ahead, 30, 30, 30, 30. Okay, so strike price is 60. So what does that mean with strike price 60? Well, I have the option to buy the stock at 60. So when we do it, you're going to be buying it at 60. 60 minus 80 is 20. That's good news, but I had to pay $5 for the luxury of having that option and walking away. So 15 bucks is what our option is going to do. So $15, which is the 80 minus 60 minus 5, is the option profit. So if you have a perfect crystal ball, you're picking this one. Right? Now, what about the loss position? If the end price is outcome B, and we end up at 20, what did I do with my long position? Lost 30. So we're down 30 with our 20 minus 50. Lost 30 bucks. And what about the option? 5. Are we up 5? Or down 5. I didn't know if you said up. I couldn't quite hear you. So we're down 5. We just don't exercise our option. So we're out $5. Okay, now you could be looking at this thinking, okay, well, you kind of see the risk variation, but how much money did I have to put in jeopardy, assuming I was really feeling good about my bet that it's going to go up to 80? How much money did I put at risk? 50 bucks. So that's kind of just one thing to put in mind here that so note, you put 50 in, 50 at risk to earn 30. Again, hindsight 2020. And over here, what did you put at risk? 5. So now you put $5 to earn 15. Yeah. Right here?
Yeah.
That was the option price. So you pay that and it's done. You for sure had to pay the option price. So that is just the option price. Is what you lose. Yeah, Isaac?
So I guess like obviously not crystal ball, so you can't always see
Is it always gonna work out safer to do the option rather than not the option?
Well, yeah, I mean, that's where we kind of got to look at the risk reward. That's why I wanted to think about it this way. So if you do the option, you're doing this now. Are you potentially going to lose all $50 with this company? Been around for 20 years. They've been making dinosaurs for forever, and kids love them. In 1 month, are you going to have all 50 go away? No.
Jurassic Park.
You know, maybe 20, yeah, Jurassic Park kids comes out and all of a sudden business is booming or business is falling, whatever. But my point is that you're not really putting all 50 at risk. It's likely going to be valued at something. So you kind of have to almost imagine what worst case scenario is. You go through a financial crisis, you know, the lowest the stock has ever dropped is a 40% tumble or whatever. You know, you can kind of come up with how much you're really risking if you just had to dump it. Versus here, you're definitely you're going to lose it if it doesn't get up to 60. So they're different that way with how much you're putting at risk and what you're looking to lose. If you really put $50 at risk, then you could go 10 more times on this and make $150 on 50, right? So you're tripling your money here, but you're also for sure losing it all here if it goes the opposite direction. Okay.
So wouldn't it make more sense to do the optional because technically professionals made more money for this?
Well, that's the trade-off, though. That's what I'm getting at here. Is that yes, you've kind of tripled your money. You could go more into it though and triple even more, but you might be, depending on what you're trying to do, and if you're a long-term investor, I mean, you're banking on kind of a short-term bet here, right? This expires this is only good for a month. Whereas this, I'm going to retire in 20 years, and I just think dinosaur company is good. So I want them for a long-term investment. So here, we're probably can be using it, and this is where we'll direct things. I know you guys, especially with Bottom Head and all that's going on, we're in kind of the gambling mode. Like, I bet it's going up. I'm going to buy an option, right? And so that might be true if you have, depending on your circumstances. If you just are looking for a short-term thing and roll the dice, it's a little bit more of a gamble maybe than an investment, depending on what information you think you've got that you probably don't have according to efficient market hypothesis. So where do these come in handy? The hedge. So now you can hedge if you're owning, if we kind of go back to the story of owning $50 of dinosaur stock and the possibility of it going down to 20, I could take another option out and stabilize my 50 so that I'm not actually running the risk of I either get 80 or 20 at the end of the month, but I pretty much try to stay plus or minus closer to my 50, right? So that's a hedging strategy to say, I want to sell the stock in a month. I got to pay for my daughter's wedding, right? And I need to have $20,000 and I don't want to run the risk of a financial crisis. I don't care if it goes up. I know that I need $20,000 for my daughter's wedding. I'm going to hedge my current holdings of 50 so that I am not too far off of the money I need in a month, regardless of what the market does. That's hedging. That's really the focus of this chapter is that, not just learning how we can gamble on Wall Street with a 1 month option or put. But you guys are thinking about the right things here. Okay, any other questions before we move on?
The strike price.
Okay, the strike and I use the exercise price. I think your textbook goes both ways too, but exercise and strike are the same thing. It's the price at which you can exercise your option is using the word exercise, and I think strike price is a little bit more of the lingo on Wall Street. Like, what's the strike price? So both ways it seems. Okay, so let's add on to this. So note, if you think Dino will fall, so you don't think they're going to go up to 80, but you're pretty sure they're going to drop, then you could short them. The big short. So how did the short work again? So you think outcome B is what's going to happen to Dino, and you're pretty sure of it. I'm going to short these babies. What are you actually doing with the short position? We'll go Dakota.
So I'm borrowing it at the price of now. and then I'm betting on it dropping off the bank at whatever price it drops. Price if I bought that much. Get back.
And then I'm gonna, so what you did is you borrowed the share, remember? So you borrowed it today, sold it at 50, and then you're saying the right thing. Then you gotta buy it back at 20 and just give the share back and you just paid $30.
That's the put option, right?
No, that's not, that's where we're gonna go with this, but I wanna first look at a true short.
Okay.
So one option is to short it, and then we're gonna look at how you can use a put option instead.
So you're saying borrow the stock when it's at 50, sell it at 50.
Yep.
And then buy it back when it's at 20.
Yep, exactly. So borrow the stock, and I was gonna write this out. So borrow the stock, basically you're kind of renting it if you wanna think of it that way. Borrow the stock at 50. And then you're going to sell it today at 50. And then you're going to buy it back. Buy it back in 1 month at 20. And that leads you to making 50 minus 20 equals $30. Well, that sounds too good to be true. It's easy. So what happens if you were wrong and we get outcome A? We owe them. So we're going to do the same thing. We borrowed. So if the price of Dino goes to $80, then you're going to have to buy it back at 80. So the rest of this is the same. Sell it at 50, buy it at 80, and return the stock. And that gives you a loss of 80 minus 20, or if we do it backwards, I guess, we do 50 minus 80 equals a loss of $30. And then what's the danger with shorting as opposed to taking long? If we did it, let's look back to the long position. What's the most I'm going to lose even if it went to zero? 50 bucks. If we short and Reddit bumps it up to $800, we lost a whole bunch, right? All of a sudden this becomes not 80, but 800. And we lost 750. In fact, it's infinite losses. So that's where we get the potential unlimited loss. So note, if the price of Dino in 1 month equals 800, you lose lots of money. All right, so that's kind of the danger with the short position. I'll leave that. Okay, so any questions on the short? Should have gone over a couple there.
I guess I understand, so like, if you want to get into stock, buying trending stocks, like, you know, a lot of it. So let's say you want to get into shorting stocks, trying to make profit off of that. How do you control about that? Like, trying to just like.
You have to just set up an account. I can't remember. Robinhood doesn't allow shorts, or does, or if you get qualified or something, maybe you can. Anybody know? I'm thinking Robinhood you can't short Robinhood, but it's not too hard to set up an account with Ameritrade or one of these other. Pretty easy to do. I saw one thing where I have some of my long-term investments in Charles Schwab, and before they allowed, this was just Charles Schwab's policy, before they allowed you to trade options and stuff, you had to kind of submit a little bit of an application. So they didn't want any Tom, Dick, and Harry just signing up for Charles Schwab. Oh, my Uncle Russ told me to go short on this or buy an option in that. So they were kind of verifying, they probably learned over the years that they should verify their own clientele, that they're savvy enough, that they know the money that they could lose like this on a short position. So every company might be different, but the bottom line is the little guy investor can set up an account to allow you to do shorts. And
Isn't that adverse selection? Like mitigating adverse selection?
yeah, it'd be a screening mechanism, yes. So they're setting up a screen, and with that, in general, you know, God bless America, maybe we should give a damn. But sure enough, oh, grandma got hurt, and grandma sued Charles Schwab, and they don't want the legal expenses. So it's basically to avoid the legal expenses, probably more so than anything, if a potential lawsuit comes up. All right, so let's set up a little table here. So, oh, I didn't do the put option yet. So the put option, let's assume that we've got a, so the put option. Let's say that we have a put price of $5. And we have a strike price or exercise price of 40. And the expiration is still 1 month. So we got a 30-day put option. It's still just the option to sell. So how much money are we losing if the price goes to 80? $5. Okay? And how much are we gaining if it goes to 20?
35?
So it goes to 20, 15. All right, so we got the price went the direction we wanted, but we only had an exercise price of 40. So I made 20 minus my put option price of 5 means 15. Okay, so we're going to kind of summarize all of them now. So just probably draw a new table here. So let's say we end at 80 or we end at 20. It's our two outcomes, outcome A and outcome B. With our long position, to recap, we made $30 if it went to 80, we lost 30 if it went to 20. With our call option, we made 15 or we lost 5. So there I just had the right to buy. With our short position, we either made 30 or we lost 30. That was the minus and the plus down here. So the short we were betting it was going to go low. And then finally the put option. Minus 5 and 15. So it's kind of nice to just look at it in this table to get the idea of either way you go, the magnitudes are going to work out kind of similar depending on which way you go. You can make money going long, going short, going call, going put, or offset your current position with a hedge. Either way. So let's talk about the hedge, just one little example here. So I currently think that it's going to go long, but again, I'm just trying to protect my nest egg. So I think that it's going to be outcome A. I'm currently holding $50 worth of stock, so I already own it. So how much do I gain if I hedged that and it turned out to be 80? In other words, I'm not going to make 30 anymore because I took out a hedge. Let's just say we took out a hedge using these numbers here.
Would it be nothing?
So what do you mean?
Short and long would cancel each other,
Short and long cancel each other, right? So if you take a short position on that, they just cancel. So then I'm back to 50, right? So I gained 30, but I lost 30. And then if I took a little bit of a partial hedge on it, if I did the put and it ended up there, I lost $5, right? But if it goes the other direction, I would have lost 30, but I gained 15. So I would have only lost 15 instead of 30. See how we can use the options to kind of at least give a buffer. And a lot of companies do that. They're just like, okay, you know, I think it's going to come down to 20, but if it doesn't, let's just buy a call option to offset some of that. So you can just do whatever your preference is on the amount of money that you want to.
That way, if you're actually wrong, it's $5.
Yeah, you're not as wrong as you would have been the other way, right? Yep, you're not as wrong as you would have been. So you paid $5 to lose less money had it gone the opposite direction. Okay, any other questions there? All right, let's see, we'll save this one for tomorrow. Let's do this. So what if now, instead of it being one particular company, Dino, which by the way, I'm going to get you down in your notes, your a micro hedge versus a macro hedge. Micro hedge versus a macro hedge, which is kind of tees up exactly what we're going to do. So with here, if we were trying to protect our Dino stock, we've done a micro hedge. So we did opposite position to protect our current investment that we had, and it was a specific asset. So a micro hedge is a hedge to protect losses for a specific asset, like dining. A macro hedge, what we're going to kind of explore next, a macro hedge is a hedge to protect loss against general market downturn that might affect your overall portfolio. So a macro hedge is one that is used to protect from losses of overall portfolio. So we might look at our portfolio and we see that it is really heavy in pro-cyclical stocks. So I've got 1,000 stocks, and I've looked at it, and I'm like, yeah, 80% of these are really pro-cyclical. What did that mean? Or story? Pro-cyclical. Hold on, I had a story. Moving with the economy, right? So that 80% of my stocks, when the economy's up, my portfolio's up for 80% of my stocks. But when the economy goes down, they fall down too, right? So if 80% of my overall 1,000 stock portfolio that I have is pro-cyclical, then I could use a hedge for my portfolio and go buy some counter-cyclical stocks, right? So they're going to move opposite. I can maybe use futures contracts or options or puts, or maybe just buy some different types of stocks, but I'm making moves to offset that feature if I think that that's going to hurt me, if I think there's maybe a recession coming. All right, so this is going to look at strategies for market risk. So hedging strategies for market risk, which would be kind of pro-cyclical with the cycles of the stock market, like the S&P 500 goes up or whatever. So stocks in general are going up, stocks in general are going down. All right, so now it's a little bit different. You've got some stocks in your portfolio that currently have a value today of $5, or one particular, we're just going to narrow it down to one stock. So today is right here. And so you own a stock today of company A, and right now it's selling at $5, and it's been on the move up. And we've got another stock here, company B, that I want to end up at $10. Backdoor myself here, company B. They've gone up and down, whatever, maybe up, maybe down, whatever. They're currently here at $10. So when we're looking at market risk, we're going to do something a little bit different with our stock picking. So when the stock market goes up, is it likely going to be up for B? Sure, because all stocks are kind of going up. When the stock market is up, is it going to be up for A? Sure, all stocks are up. So we're saying that in general, stocks are moving, these two stocks are moving together, but you're able to, through your analysis, figure out, we think, that when the stock market's up, it benefits B more than A. It benefits B more than A. So in an upswing, company B tends to grow by 50% when it's up. So 50% might put us at $15. We have a 50% upswing in price. Whereas company B, they also go up, but it tends to be just at 20% up. And then in a bull market, here's my red here, in a bull market, the same is true. This one tends to go down 20% when the market's down, but this one tends to go 50% when the market's down. All right, so when it goes down to 50%, your lines might not line up here perfectly. We got, 250. So we can, once again, kind of analyze both of our stock positions with our portfolio now of company A and company B. So when the market is up, what we call a bull market, right? When the market is up and we have a long position in one, let's just use one share of B, our stock goes from $10 to 15. So we're up $5. And with our, if we take a short position in 2 shares of company A, market is up, we took a short position in company A, then if we, and this is with 2 shares, by the way. So what I'm trying to do here is I've got $10 of each company. So with company A, I've got $10 invested in company A, and I've got $10 in company B. So I've got 2 shares of company A. So my $10 turns into what with my short position?
14.
14. With a 20% increase, when the market's up, 20% of $10,
Oh, $12.
$12. So I'm plus or minus 2. If I took a short position in company A. So then between the two, I made $3. Because I took a short position. So I took a short, not a long. So I'm trying to do a little hedge here on market risk. So when the market's up, I can pick stocks that lets me be up in the money even when they go at different rates. So when the market's up, I'm going to short a company that's not going to climb as much as the up. And then I'm going to do the opposite for a down market, which we will pick up tomorrow. Cliffhanger on that one.